3 seconds for the ADP jobs report from Lease Maniacs. He's here.
Yeah, thanks, Joe. ADP saying the private sector grew by 89,000 jobs in the month of September. That is a miss compared to the stronger estimate of 160,000. The goods sector up by 8,000, the service sector up by 81,000. All of this compares with a non-farm payroll estimate for Friday, which includes government and the private sector, of 170,000. Looking at the job growth by business size, small businesses doing their part, medium businesses doing their part, up by 79,000. It was large businesses that saw the decline, down by 83,000. That's a big change from what's been going on here. And by sector, there it is, the leisure and hospitality business doing its part, up 92,000. Financial activities also stronger. Kind of curious given what's happening in the mortgage market. Construction also doing well, but trade, transportation, and utilities down 13,000, and professional business services down by 32,000 right there. Wage gains also showing quite a bit of moderation. Those staying in their jobs got year-over-year changes of 5.9%. That's one of the lowest we've seen since 2021. Job changers, 9%, still high by the historical series here, but down quite a bit from, it was, I think, 14, 15% just about a year ago. So some good numbers there when it comes to the inflation outlook and the impact potentially from wages. And just a quick caveat, guys, as you know, this number has been running quite a bit hotter than the BLS number, about 100,000 over. So they don't claim to be trying to mimic it or mock it. They're just doing their own report on what's happening in the job market. Joe?
Steve, we keep waiting. 89. Maybe that's the beginning of something. Stay with us to talk more about the new data. Let's bring in Neela Richardson, chief economist at ADP. How many of these do we need before it becomes a pattern, do you think, Neela? It's still a pretty strong economy, still a pretty strong jobs market, but are we seeing some cracks developing?
You need two more, Joe. Good morning. We've seen a weak month sandwiched between two stronger months before. The last time for the NER was in June of this year, and it's not uncommon to see that in a variety of labor market series. So I would like to see a few more, at least a couple more months. But this is really a small firm, large firm story at the moment. Large firm hiring has been weak all year. And this particular month of September, large firms pretty much wiped off all the hiring gains of the previous month, which was a strong month for large firms relative to what we saw all year. So, yeah, small firms are still hiring. Small firms are overconcentrated in the leisure and hospitality sector, which is going strong. But that large firm weakness is a consistent trend that we can actually declare right now.
Right. Neela, we've had people on who've said we're already in a recession, maybe in the very beginning of a recession that turns into a couple of down quarters or flat quarters of GDP. Is there any way that's possible given what you look at?
You know, people have been saying we're in a recession for the past 2 years. So it's hard to say that a definitive moment has arrived with this data point. I will point out, though, that hiring has been solid and we're still under 4% unemployment. So if it's coming from the labor market, I think it's still too early to call a recession. But there's reason to be concerned. I mean, we've almost halved the number of private sector jobs this month. And so looking out into the next 3 months of this year, I think there's reasons to think that the labor market is loosening quite a bit, and how loose it gets is, of course, something we'll be keeping track of.
Steve, if you could ask Neela anything, what would you ask her? Because it's your chance.
I'm going to ask her a question in just a second, Joe, but I want to just point out, again, the yields are down on the 10-year here, as well as the stock market getting a little bit of a bump from this number. Which I mentioned because it was what we talked about in the 7 o'clock. We had been talking about this rise in yields being linked very much to issuance. We're also seeing it is linked as well to outlooks for the economy. There's a big economic growth
there was a big jump after the JOLTS report.
Yeah, go ahead, Beck. Sorry.
Yeah, Steve, to your point, yesterday there was a big jump in yields after the JOLTS report was stronger. Yeah, showed a stronger job market.
And
so
it sets up
this is again.
It sets up the jobs report on Friday as being very significant. There are some errors in this thing, but that's not what I want to ask Neela. Neela, can you tell me or explain to me how you guys treat the strikes that are going on. Did that show up in the decline in trade, transport, and utilities? And do we then think that maybe this number is a little bit weaker than it is actually a little bit stronger than the headline appears?
Here's why you might see some differences. There's a lot of differences between today's number from ADP and the BLS report, but one of them is we count striking workers on payroll. We don't ask if they've gotten a paycheck. We've asked, are you still employed? And they are. And so they don't show up in this number in the same way they might show up in the BLS report. But going back to the bond market, I will point out that where investors might really cheer this number is when you look at pay growth. Remember, pay growth stayed for job changers in double digits, according to our data, for 2 years. We finally broke the seal on that. We're seeing for job changers that those most sensitive to the labor market conditions, that they are now below 10%, 9% year over year. And after moving sideways, wage growth for job stayers is finally seeing declines.
Let me rudely interrupt you to give you a chance to praise your own number here, which is whatever people think of the top line number, your wage data has way more actual data points of employees' actual wages than the government does. How many points of data is in this wage data here?
We can match 10 million workers over a course of a year. We have 22 million workers at our disposal just for pay insights. And I'll give you another number, Steve. We looked at new hires. So these are people who are not matched. They're just in the sample. 22 million workers every month who've started a job in the last 3 months. If you isolate hourly workers, that's 60% of the sample, the hourly worker pay per hour has not budged from $17 since February of 2023. This is a wage pattern that is not accelerating. It's at a standstill for hourly pay. And that's why if you're concerned about wages prompting inflation, you might want to ease your concerns right now, because that's not what we're seeing.